Hello, people. Let's give it a couple of seconds. Okay, talking about stop losses today. Thanks for joining us on this fine day outside. Not that we can go anywhere, but I hope you're all managing to stay fairly sane. I'm going to talk about some stop losses today and the importance of them and how to be a bit cuter when placing your stop losses to try and stay in trades just that little bit longer if you can, and give yourself every chance of making money. So without further ado, let's crack on with the first slide. So this is an introduction. This is what I'll be going through today. We're talking about using arbitrary numbers of pips as stop losses or using specific levels. Talking about why the stop loss is the most important part of your trade. Also talk about some risk reward, talking about obvious levels in the markets and how to avoid the dreaded stop hunt. Talking about patterns and how they don't always play out as you'd expect. Also talking about the risks of holding positions overnight and why spreads are important in that. And then I'm just going to run through a couple of examples on my charts of how I've set up a few trades over the last couple of days, things that I'm looking at live at the moment, and where I would be placing my stop losses on those trades as it stands. So firstly, I'm going to talk about pip levels, pips or numbers of pips versus levels in the market. Now, if anyone ever tells you to take a trade and just place a 20 or a 30 or a 50 point stop on something, just chucks out an arbitrary number like that, then that's a cue for you to ignore them. Professional traders would never, ever tell you to place a stop loss at some arbitrary number of points away in the market. It just wouldn't happen. You know, we're looking for the maximum amount of risk reward on any trade that we take. And therefore, rather than just saying, I don't know, just chuck a 25 pip stop on this, if there's a level at 19 pips away, then that's where I'm going to place my stop, because my risk reward is going to be better by doing that. So a stop loss should always be a level based on the market. What you need and what your stop loss is designed to do, if it's breached, it will prove that you are wrong on a trade. You want to see the price invalidate your view by giving you factual based information that you are wrong. And that evidence comes from the most logical support or resistance level, which is nearby to your entry. If that is breached, then it's time to get out your trade. Your original thoughts as to why you got into a trade have been proved incorrect. And there's absolutely nothing wrong with that. Stop losses are part of the business, and they're an essential part of the business in order to keep you and your account to keep growing over the long term. Now, a properly placed stop truly is the starting point of any successful trade. We've got this diagram on the screen. The stop loss is bang in the middle of that. A properly placed stop loss really is the, as I say, the starting point. From the stop loss, it means that you can take a calculated level of risk on all of your trades. You're obviously going to be aware of how much potential loss you face if the trade doesn't go your way. It will also determine your risk versus reward. So if you're taking a trade and it's a 20 pip stop because it's a level, not because it's an arbitrary number, then that will determine how much risk you're taking, and therefore you should be looking for multiples of that stop loss, so 40 or 60 pips as a take profit, or at the a level higher up on your charts that you've defined. If you have a stop loss, it means you're taking a planned approach to the market. You're not just gambling and punting and taking any sort of form of trade that shows you've got a plan in place. You know where your risk is. You know how much you potentially could lose on any trade. So by having that stop loss, you're working to a plan. Without a plan, I can guarantee that you're going to fail. Now, position sizing, once you've got your stop loss, then you can determine how much you should be trading or how much exposure you should take on any trade. Without a stop, it's impossible to have a precise position size, and you've got absolutely no control over your losses. And in a market like this, where we're seeing huge moves on a daily basis, if you go into a trade without a stop loss, you can end up blowing your account in one trade. Now, to calculate position sizes, I know a lot of you are trading using CFDs and you're trading using lot sizes. There are plenty of calculator tools around for you to use to work out specific position sizes. If you don't know where to look, send me a message and I'll point you in the right direction. I tend to do quite a lot of spread betting as opposed to CFDs. So just to keep it simple on this and how I would work out a trade size, if I've got a stop loss of 50 pips on a trade and I want to risk a maximum £50 on that trade, then I would risk quite simply doing £1 a point on that trade. And obviously calculations will get more complex than that if you have random numbers of pips, or if you're trading on multiples of £1 a point, or risking much more than £50. But as a rule of thumb, I only ever risk 1% per trade, or 1% of my account capital on a per trade basis. Now, the next part of information that I want to share with you is about obvious levels. Now, professionals are very good at spotting price levels and where the majority of traders place their stops. It's a well-known fact that 80 to 90% of people lose money when it comes to trading. And in that 10%, there'll be people that are hunting stop losses on a regular basis, know where people are placing their stops, and they'll be looking to squeeze those people out of their trades at every opportunity. So the numbers to avoid are round numbers such as 00. So if you're trading, I don't know, let's say the FTSE 100 and it's trading at 6,000, don't place your stop loss at 6,000. It's such an obvious level. These levels also tend to act as magnets for price. So if the FTSE is to say trading around about above that 6,005, the chances are it's probably going to go down and try and test that 6,000 level. It's a big psychological level in the market, which people will often target. Same with 50s as well. It seems to work on that basis as well. So if we're talking about, I don't know, 5,550, then prices can often magnetize towards those levels. So don't have your stop losses at those. Just try and not be so obvious when you're placing your stops. Swing highs and swing lows, again, they're obvious points. If you see a recent swing high, don't just go 1 or 2 ticks above. The chances are you're going to get flushed out, and your stop losses are going to get taken. And obviously major supports and resistance levels, go back through multiple time frames if you can. Ian's going to do a webinar later on multiple time frames. So he's going to be looking at weeklies, he's going to be looking at dailies, and various sort of hours or minutes in between, to try and build a bigger picture and try and highlight those major key supports and resistance levels. The next thing I'm going to touch on is imperfect patterns. So anyone that's done any kind of education when it comes to trading and looked at trading patterns will see these lovely textbook examples of trading patterns that we all use to obviously teach from. They don't often work out that way. Often you'll see patterns that are very much imperfect. So this is an example here of a head and shoulders top. We've got the left shoulder here, we've got the head there, we've got a break of the neckline there before then a move higher to form this right shoulder. In an ideal world, what you would see on a break of a head and shoulders top is a retest of that neckline before it then heads lower. In reality, what you may see is something a little bit messier. You'll get a breach of that neckline. And if you're trying to set sniper entries, so you're actually trying to set your limits on that neckline, then you're probably going to have a stop loss just a little bit above that. That might not be the most sensible place. You've got to look at what the price action was doing around here to give you a few more clues about where to place your stop loss. So often, people will get chopped out of these positions. They'll ultimately be right, but because their stop losses are placed either too obviously or they've not taken into account what's previously gone on around here, they can end up getting stopped out when they would have in fact been right by just being a little bit cuter with the placement of their stops. This is an example of a swing failure or a trap, and this is exactly what we talk about when these professionals are looking to find your levels in the market. Often markets will overshoot resistance levels and they'll create these traps. It's a well-known strategy in the market, and other participants will be looking to pounce upon this kind of setup. In this instance, and what I've drawn here, the overall trend is bearish. So we're starting from up here. The overall trend is lower. So we're expecting prices to continue lower, and therefore we're looking for an entry to go short. So it might be that you've taken the first retest of this resistance here. You've got short. You've got your stop loss just above that level. You then see a move lower. You're thinking, great, this is looking good. But all of a sudden you get a move back high to retest this level here where you've initially initiated your short trades. And then you can see that little bit of a flush above that level. And often you'll see these type of candles, shooting star candles that will form. And that is a cue that you've been probably stop hunted at that level. So when you see a candle like this, we go through the psychology of that. The price has opened at the lower part of the candle. It's gone all the way higher. it's been rejected and sold all the way down to close back inside that resistance level and then head lower towards the target. So be careful when you're placing your stop losses and looking out for these sort of patterns. Obviously, I'm always a fan of using a stop loss. I do try and give them a little bit of room and add an extra bit of padding to these trades where you can. Often you can see, and what I'll use is if I get a retest of a resistance level like this, I'll look to see what it does on a closing basis. So it might be that my stop loss is actually up here above this high, just for that extra bit of padding. If then I see a retest of my level here and see a candle like this posted, I'll look to see what it does on a closing basis. So if I'm trading on a 60-minute candle and I see this post, I've seen a new high, but then it closed back below, then I can then lower my stop loss to above the high of that candle to lower it down from this initial level up here. Something else to bear in mind when you're placing stop losses is spreads. Now, obviously, we all trade with different brokers and spreads are different wherever you trade. What I would always suggest is that you try and add your stop losses, sorry, you add your spreads onto the stop loss itself. So if you are buying or selling, let's say you're buying euro, US dollar, and you have a stop loss at 106.93, then you would add the spread to that to include that in your position size calculation. So if you've got a 1 pip or a 2 pip spread on euro US dollar, rather than having it 06.93, put it at 06.91. So then the price actually has to go through your level to the sell to the buy price in order for you to get stopped out. Now, what also is worthwhile bearing in mind is what happens overnight. If you do carry positions overnight, then be aware of what your broker changes on how they change their spreads, because a lot of brokers actually widen their spreads overnight. Some keep them fixed, some keep them wide. So it might be that you've woken up one morning and have a look at your charts and think, how the hell have I been stopped out on that? Well, it is because they often do widen spread. So you might need to make small adjustments to your positions and your stops if you are indeed carrying something overnight. That pretty much concludes the slides. I'm going to come on to some live charts now just to show you a few bits. Contact details there if anybody does have any questions about what I've gone through today and wants to get in touch. So just stop sharing that for now and share this screen here. Okay, so I've traded a couple of bits myself today. I posted on the chat that I was looking at DAX, and specifically what I was looking at was the 1 hour chart. And this is a classic swing failure setup. So yesterday I had been long of the DAX on the back of this inverse head and shoulders bottom that you can see on the chart here. It played out very nicely. We saw a breakout above the neckline, a very small pullback to retest, and then pretty much a straight line move higher throughout the overnight session and into the first part of this morning. Now, what I had on my chart was this resistance level drawn here, and I'll just turn that red just to highlight it. So we had a high here on the 12th of March. We then had another retest of that level on the 13th of March, both of which obviously capped the upside. We then saw a fresh push higher today and a little bit of an overshoot of that level. So at that point, you know, there are probably a few stop losses that are triggering off because they're short and they're thinking, okay, that's the point now that I'm wrong. In fact, what we actually saw was a little bit of an overshoot. And when we saw this reversal candle here, a shoot to new highs and a close back below the resistance level, that was a cue there for me to sell it. And when you're selling, waiting for actual reversals to happen, then you're okay to put your stop losses just above these highs. Then you've got good risk reward on your trade. In this instance, if you had sold at that level on the close of that 1 hour bar, placed your stop above there, we had a 216 pip stop. So I would have added on a pip or two for the spread, depending on who you're trading with. And I'm actually looking for a pullback towards the neckline of this head and shoulders bottom, at which point then I think it could be a buy, and then we could see further upside. So on that setup, we've got 3.4 risk reward ratio on that trade. So that was an instance where we saw a bit of a swing failure, and I think we saw it on a number of the other markets as well. Let's just clear all those drawings. So this was the FTSE 100. I prefer this one actually. So again, we had some levels here on the 13th of March, and again on the 13th of March, we saw a breach of that level. Didn't close above that level, in fact, reversed to close back below. Again, there is an opportunity to sell with a stop above that high there. Now, when you're looking for trades and setting sort of sniper levels or specific entries, which we do every day on our intraday calls, this is Aussie CAD. So I'm just going to, I've got a fresh chart here and just going to throw up how I would potentially trade this. So first of all, the overall trend for me is bearish. This is a monthly chart here. Obviously, we've seen a very big candle here, but overall the trend is lower. Whether or not we've formed any sort of reversal, not entirely sure. But I'm going to be looking to trade with the overall trend, which for me is heading lower. So this is a hourly chart. This is the most recent swing move. First of all, I'm going to take a look at Fibonacci level on that. Get rid of the 38.2 and the 50 because they're not relevant. What we do have though is the 61.8, which is looking though it's going to work quite nicely. So if I was, or price was down here, then I'd be looking at this 61.8, looking at some levels to trade. I'm pretty sure I probably would have had a level around there to sell it at. So where do you place your stop loss in this instance? So the chances are when we trade, we're not going to be pinpoint every time. So obviously having a stop loss somewhere like that, really tight to the level isn't the wisest of ideas. So look back across the chart to see where the price action has been previously and where there's been clusters of supports and resistance levels. Obviously, there's a bit of a cluster of price action around here. What I also like is when you see these big candles, these big thrust candles, engulfings or Marubozu candles, which we have here. So this on the hourly chart, when you see these big impulsive moves to the downside, I often like to put stop losses above those, because for the price to actually engulf or move back above that big down thrusting candle would take quite a lot of effort. So placing a stop loss above something like that would be, I think, a more sensible level to put it. If you wanted to be even safer, then you could put it above a high there. But obviously, I want to keep my stop losses. First of all, I think I'm not going to get hit in order to stay in a trade, but also at a level where the risk reward still is favorable. So in that instance, we would have had a 73 pip stop, maybe call that 75 if we were adding on for the spread. And if we are confident in our beliefs that the downtrend is going to persist, then there's no reason why we couldn't be targeting a move down to these lows down here, at which point you're looking to try and make 8.3 times what you've initially risked on the trade. So that's just another example. So look for things like big down moves or big Marubozu candles up or down to try and place your stop losses above those. Don't obviously look at the obvious levels like the 6,000s in or the 0.6000. That could be an easy magnet for price action to head towards. So hopefully that has been useful for you. If you do have any other questions about what I've gone through, then please feel free to get in touch. As I say, we're going to be doing a few more of these, and we really do welcome any questions that you've got. So please send them in, get in touch on Skype or on Telegram, and we will catch you a bit later when Ian goes through multi-time frame analysis. So thanks for listening and speak to you soon. Cheers.